This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the third week of June with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Already episode 7, Patrick. Nice to see you.
I know. It feels like just yesterday we started. Good to see you too, Terry.
The markets, starting things out today with the markets. Over the past month, it's been kind of a steady rise with the possible exception of Friday the 13th, which seemed to be a big blip.
Yeah, so especially end of day, once the Israel decided to take on Iran, S&P 500 futures indicated we'd have a lower open probably on Monday. You know, as obviously very sad incident. The way that the markets generally react to these things is you tend to see oil prices tend to rise, especially when it's an event in the Middle East. You do tend to see stock markets, which represent risky assets. You tend to see them sell down. You tend to see things like U.S. Treasuries, U.S. dollar, gold, tend to rise. Kind of these are seen as safe haven assets. But if we kind of look where the markets are here today on Tuesday, there's a little bit more green on the screen than we would have expected. You know, the market is perhaps pricing that the contagion from this is maybe not going to be as widespread as it could possibly. It's still, of course, very early days. We're very hopeful that this will come to some type of resolution sooner rather than later. But gold holding, Bitcoin is down a little bit. You know, for the week, if we kind of just take a look at bond yields, basically the same. Yeah, Canadian and U.S. equities, especially if we kind of look out longer term, is that we're generally pretty happy the direction of markets. But these type of geopolitical events, they're meaningful. They can often go and highlight other problems in the market, but they tend to be short in nature. So, we'll continue to kind of monitor. But just looking at WTI today, it was at $77. So that's quite a bit of a jump since our last podcast.
Now, it seems like you may have just skimmed over briefly the meniscus of it, the geopolitical events and maybe political events with the G7 happening this week and Trump leaving early because of the Israeli-Iran conflict that's going on. But and Trump leaving the G7 the day he got there was kind of like they threw him a party, and then all of a sudden, no, I'm leaving early. So that was weird. How does that? Is there a little more in-depth look at how those geopolitical events can affect our investments?
Yeah, probably because Trump's not from Alberta. He couldn't get a tee time at the Kananaskis golf course, right? Because, we tend to give Albertans the better rates. I think as retail investors, it's easier for us to digest how we feel about geopolitical events. You know, when we think of how institutional investors think, and they generally think longer term, and they spend, oodles and oodles of time and money doing, research on fundamentals. It's generally retail investors that react to these geopolitical events. You and me and our friends, we probably choose to keep, money that we maybe we're intending of putting in the market. We leave it in our pocket for a day or two. And that incremental less demand by investors takes away from momentum in the market. And so you tend to see things like the Toronto Stock Exchange, the NASDAQ, the New York Stock Exchange, global exchanges. They fall on that lack of demand, and they create some momentum. Objects in motion tend to stay in motion. So until some counter news comes up to offset that negative news, is that, markets can kind of continue to move down. Just like markets can get kind of carried away to the upside, they definitely tend to get carried away to the downside. Things tend to get overbought and things tend to get oversold. So you're really looking for that counter piece of news. And so whether or not, with an event like this, you'd be looking for some type of news that, one of the two parties is looking to make a deal and to settle it out. Or what you're also looking at is that perhaps assets get too cheap or too expensive, based on, again, fundamentals. And so, what we want to connect our listeners to in these podcasts is that it's things like fundamentals, so earnings and profits, that drive stocks. And then stock markets are markets of stocks. So fundamentals drive stocks, stocks drive markets either up or down. We really want to focus on profitability for the medium to long term. But you're right, these geopolitical events, they're going to hit the headlines in the short term, and they're going to affect primarily retail investor decisions in the short run, either, people keeping their hands in their pocket or people sending money into their investment accounts.
Does that kind of have like a geopolitical event compared to a political event, say, like imposing tariffs or an agreement between the US and Great Britain on trade, and one that wasn't met on Monday at the G7 between Trump and Mark Carney? Does that also have a big effect on things, or not as much, or more?
Yeah, so it's great. So it's great. We've in a number of our podcasts, we've included some, call it, macroeconomic events into our conversations that we have, and there is this connecting the dots between the microeconomic picture. So we kind of look bottom up, and we're kind of looking at businesses and companies and everything that they're kind of dealing with in either their supply chain or their costs or what their consumers are doing. And then, yes, you have these big macro events, which should be kind of longer term, like a macro event, like a trade deal, is that you would hope that a trade deal would be, in place for a longer period of time. If we think about the US, Mexican, Canadian trade agreement, which was kind of NAFTA 2.0, which was done in Trump's first term, is that it largely is kind of held up so far, albeit we're looking for kind of a new deal. So, we had kind of known economic conditions, known trade arrangements for many, many years, certainly like a 5-year business cycle. Whereas these geopolitical events is that they are looking beyond the dollars and the cents. And so they throw a wrench in the system that, we weren't calculating on, or we weren't expecting. But like history shows their impact on the markets being more short term. So I would kind of categorize those geopolitical events as generally, unless they get really kind of carried away, short term events, whereas these big macroeconomic events, like a trade agreement, or like any, if we think of a climate accord that would come out of something like a G7 event, is that should be longer term, and the implications from, any deals that come out of that, we should see either the benefits or the negative aspects of it impacting the markets over a longer period of time.
With that kind of instability for someone who might be on the doorstep of retirement, that
Yeah.
could have a heavy effect on whether or not they take the step to retirement or not, because they're wondering with their nest egg, is it going to be enough? But is there a calculation that people can use? And some people may already know this, but for others, it may be new information.
Yeah, I can think of many times in my almost 30-year career of doing this where people have retired, and they've retired into an unexpected recession, or they've retired into an unexpected downturn in the market. It would seem like just bad timing, but the reality of these things is the market, tends to work itself in equilibrium, and we tend to see some weakness in the global economy as being something cyclical, and it doesn't follow a regular pattern. But you're right, investors are, when they're ready to take that leap into retirement, where they're no longer contributing to their savings, and now it's time to turn the faucet on to have their savings start to pay them, they kind of gravitate to what others are doing. And so I think you and I have even talked about the 4% rule before as kind of being this retirement plan that you can do on the back of a napkin, per se, where you can kind of take a look at your investment savings and say, this money may have to last me 30 years. You and I have talked about longevity when we were talking about what to do with CPP, and should I defer or not, right? And so average life expectancy is generally getting longer. So somebody that's retiring at 65 could very easily live to 95. So a 30-year retirement horizon. So this idea of this 4% rule would be a very kind of simple calculation where a person can say, aside from my old age security, aside from my CPP, aside from maybe any private pension plan I have, defined benefit pension plan I have, is that I have some savings. And so if I wanted to kind of have an estimate of what I could count on being there on an annual basis, we take this 4% rule. So let's just say I have $1 million. Let's just say I have $1 million, and I could quite comfortably estimate that if I were to draw out 4% of that a year, or $40,000, and then every year after that make an adjustment for inflation, this becomes a very simple measuring stick to go and say, I should be okay if I estimate that that is enough for what my retirement budget is. Now, there are some other assumptions that are built into this 4% rule. Is that we don't know, every investor is a little bit different in terms of what their investments look like and what type of investment returns they've had. So the 4% rule is based on an investment portfolio that's probably 50% in safe assets like bonds or GICs and 50% in equity investments, kind of estimating that probably returns are going to be in that 4 to 5.5% range. By planning to withdraw 4%, planning to make an adjustment for inflation for every year, is that if a person was making a rough calculation to say, my government pensions plus my 4%, is that going to be enough? That maybe that gives people enough confidence to say, I think I could probably retire. There's probably enough money there. Now, the work that we do at Leonard Wealth Advisory is that we want to do a more detailed retirement plan where we take into consideration tax. We customize our assumptions based on historical rates of return that our clients have had with us. Certainly a more sophisticated, forward-looking estimate of where somebody's retirement income is going to be, what their estate is going to look like, pull together all of their assets, because some assets are tax sheltered, other assets are not. We have some simple planning tools like the 4% rule, but really what we want people to have is a more sophisticated retirement plan that takes into consideration all of the elements together of what their retirement is likely to look like.
So ballpark is more of the 4% rule is like a ballpark sort of measuring stick, and then you go from there.
100%.
Very good. The Leonard Wealth Advisory Group of BMO Nesbitt Burns, Patrick Leonard. That wraps up the Wealth Roundup for the third week of June, episode number 7. Thank you, Patrick.
Have a great week, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.